beach, watching the tide roll out at like absolute lightning speed.
Yeah, just completely draining away.
Right. That is exactly what the massive tech liquidity drain felt like today. But, instead of an empty beach, you were looking at a collision.
A pretty violent one, too.
Exactly. You have this historic corporate capital vacuum eating rising global interest rates, all while a highly volatile and physical reality just continues to unfold in the Middle East. Welcome to our deep dive into the source material. I'm Daniel, the practitioner.
And I'm Mira, the analyst.
So today's tape was honestly a masterclass in market whiplash. I mean, U.S. equities suffered a significant intraday reversal on Wednesday, June 3rd.
Yeah, the S&P 500 actually peaked early, right around 7,625.
Right, but then it just bled down all afternoon. It closed at 7,544.
Yeah.
And the Nasdaq followed practically the same path. It dropped from a high of nearly 30,780 to under 30,500.
Meanwhile, the U.S. dollar steadily firmed up to 99.53. And, the 10-year Treasury yield climbed to 4.491%.
Plus, we had crude oil surging intraday. It got near 97 before settling at 96.27.
Which is a huge move.
It really is. So here's a quick preview of what you are getting today. We are unpacking the hawkish pivot from the Bank of Japan, the conflicting ceasefire signals out of the Middle East, the U.S. Fed's stern warnings, and of course, those record-breaking capital raises from Alphabet and SpaceX.
Right, the ones that are just completely sucking liquidity out of the market.
Exactly. But before we dive in, a quick reminder for you listening, this deep dive is for market context and discussion only. It is not personal investment advice.
Yeah, definitely not an investment recommendation.
Okay, so let's start with the overnight backdrop. Yep. Session 1. What set the stage before the U.S. session opened today?
Well, the real overnight shocker hit the tape before most of the U.S. was even awake.
Oh, yeah.
Yeah, at 4:32 a.m. Eastern Time, Bank of Japan Governor Kazuo Ueda delivered some notably hawkish remarks.
It's pretty rare for them.
Exactly. He warned that the recent surge in crude oil is actively pushing up core CPI and general prices in Japan. And he stated that the BOJ might need to raise rates sharply and swiftly, to avoid a huge burden on markets later.
Right. And we should quickly connect that to the broader theme. Like, global liquidity draining puts immediate upward pressure on yields everywhere.
Yeah, because if Japan raises rates, that cheap yen carry trade gets a lot more expensive.
Exactly. But we have to look at the geopolitical carryover from Tuesday evening, too, because that's what's driving the oil surge Ueda is worried about.
Right. The market was already digesting some severe kinetic military escalation. I mean,
Right.
U.S. forces disabled an unladen Iranian tanker and struck Keshan Island.
Yeah, and then Iran launched strikes that actually hit Kuwait's civilian airport.
It's just a huge escalation. But then, fast forward to Wednesday morning at 6:05 a.m. Eastern Time.
Right.
President Trump heavily promoted a diplomatic breakthrough. He suggested a deal to reopen the Strait of Hormuz could happen by Labor Day. But then Iranian officials pushed back, stating, no tangible progress has been made.
Okay, wait, let me push back on this a bit.
Yeah.
Because we have this reflex in the market of treating these geopolitical attacks as, like, random, unpredictable disasters.
Yeah, people just see the headlines and panic.
Right. But if you look through a game theoretic lens, isn't this geopolitical brinkmanship as negotiation leverage? Like, this is a calculated way for both sides to establish dominance right before they sign an agreement.
That makes a lot of sense. It's violent posturing, basically.
Exactly. So just to wrap up the morning setup, heading into the U.S. Open, investors were caught between two forces. On one hand, you have markets pricing ahead of physical reality, hoping for this peace deal.
Right.
And on the other hand, you have the very real hawkishness from Japan. Okay, we're going to take a short break, but when we return, we will explore how the U.S. macro data and Fed speakers just totally threw fuel on the fire.
Welcome back. So let's look at the cash session, session 2. What moved markets during U.S. trading hours?
Well, it started with some really hot macro data colliding with what I would call extreme treasury optimism.
Yeah, that's a good way to put it. At 9:45 a.m. Eastern Time, the U.S. ISM Services PMI was released.
Did it beat estimates?
It did. It came in at 54.5. But the really critical detail here is the prices paid subindex. It remains scorching hot at 71.3.
Wow. 71.3.
Yeah, and that was coupled with strong factory orders, which came in at 4.8%.
So if the economy's running hot, businesses are paying massive costs, which means inflation is still a very real problem. But then we got a totally different narrative literally minutes later.
Right, at 9:51 a.m. Eastern Time.
Yeah, Treasury Secretary Scott Bessent was testifying, and he focused entirely on targeting a sub-4% deficit through growth initiatives. He actually dismissed the recent inflation as just a short-term blip.
A short-term blip. I mean, is he just ignoring structural realities here?
That's exactly what I was thinking.
Because if the Fed is actively pointing out that AI infrastructure and energy bottlenecks are keeping inflation sticky, isn't Bessent's whole narrative, dangerously out of touch with what the central bank is actually seeing?
Yeah, and the Fed speakers completely undercut his optimism pretty much immediately.
They really did.
At 10:04 a.m. Eastern Time, New York Fed President John Williams noted that inflation will likely stay high through the rest of the year. He explicitly blamed energy and AI tech demand.
And then it got even more hawkish later. At 3:50 p.m. Eastern Time, Dallas Fed President Logan stepped up.
Right.
She struck an explicitly hawkish tone. She warned that current monetary policy is just not restraining the economy. And she said corporate earnings are going gangbusters.
Which is an incredible phrase for a Fed president to use.
Yeah. And she even hinted that further rate hikes might be necessary. Not cuts, hikes.
Right. And that connects perfectly to discount rates as financial gravity. I mean, the realization that inflation isn't fading, that we might even get hikes that force yields higher, and that financial gravity just dragged the S&P 500 down for the rest of the afternoon.
It just couldn't fight the gravity.
Exactly. So to wrap up session 2, resilient U.S. demand and these hawkish Fed reality checks drove the intraday sell-off. We're going to take one more short break.
And when we return, we will look at the historic corporate capital raises that really drained the market's liquidity today.
All right, we see the macro picture, but what about the micro? Session 3. What's our corporate events recap, and what should we watch next?
Well, the micro side had some massive news right off the bat. At 9:32 a.m. Eastern Time, Alphabet announced an upsized equity capital raise.
That was huge, right?
Unbelievable. $84.75 billion. They are pricing 25.46 million shares at $355.19.
Wow. Over $84 billion.
Yeah, and management reaffirmed a staggering $180 billion to $190 billion in full-year capex.
Just to build out their AI infrastructure.
Exactly. And even though they announced that Gemini monthly active users have surpassed 900 million, the sheer size of the raise is just a prime example of equity issuance as mechanical dilution.
I mean, you have to connect Alphabet's move to the carryover news from Tuesday evening, too.
Right, the SpaceX news.
Yeah, at 5:11 p.m. Eastern Time on Tuesday, SpaceX filed for a record-breaking $75 billion IPO at $135 a share.
Also to expand AI, computing, and satellite networks.
Exactly. So if we synthesize this, between Alphabet and SpaceX, you have roughly $160 billion in liquidity just being vacuumed out of the market.
It's practically a black hole.
It really is. It vividly illustrates this idea of AI capex as a cycle-agnostic arms race. Like, they don't care what rates are, they're just going to build. And it really shows how tech mega capex is masking broader fragility in the market's ability to absorb all this new supply.
Well, folks, after watching the S&P 500 bleed out all afternoon, it's really no wonder Elon Musk is trying to raise $75 billion for SpaceX.
Oh, no.
He probably took one look at soaring oil prices, hawkish Fed comments, and Alphabet's massive capital raise, and just decided it's finally time to get off this planet.
I don't blame him.
Right. If looking at your tech holdings today feels like getting hit by an intercepted missile, just remember, the market is a lot like the Strait of Hormuz right now. Volatile, confusing, and Trump promises it'll all be fixed by Labor Day.
That is painfully accurate.
Let's just go grab a drink before the ISM Prices Paid Index makes happy hour too expensive.
Seriously. We might need to. But before we do, here is what we need to watch next. For Thursday's catalysts, we have the morning U.S. labor data cluster, which includes initial jobless claims, productivity, and unit labor costs.
Lots of data.
Yeah, and we'll also be hearing from Fed speakers Barkin and Daly. Plus, we've got the short-end Treasury supply auctions and the afternoon EIA natural gas storage report.
All right, now it is time for our 2-minute bonus session, paper trading.
My favorite part.
So we use this segment to test our daily macro analysis with a virtual $10,000 portfolio. It's constrained to 13 macro ETFs.
And how is a portfolio doing today?
Currently, it sits at $11,273.87. That is a 12.74% return, which is solidly outperforming the S&P 500's 6.0% over the same period.
Nice. Okay, I'll go first for my trade.
Go for it.
So I'm selling $1,100 of the Communication Services ETF, ticker XLC.
Okay, to escape the Alphabet dilution.
Exactly. That mechanical dilution from Alphabet is just too heavy right now. And I am going to buy $1,100 of the energy ETF, ticker XLE.
Makes sense with the oil surge.
Yeah, my justification is basically avoiding the gravity of rising discount rates that Logan and U8 has signaled.
Yeah.
And I want to seek protection in energy. The Middle East kinetic escalation proves that energy shocks act as a delayed consumer tax, and I want to hedge against that.
Well, I completely agree with the energy hedge, but I'm going to opt to sell $1,120 of the technology ETF, ticker XLK, instead.
Oh, interesting. Why XLK instead of XLC?
Well, if you look at our portfolio, we are heavily overweight in tech. It's over 49% of our holdings right now.
Oh, wow, that is high.
Yeah, and that makes us highly sensitive to this massive SpaceX and Alphabet liquidity drain, not to mention the hawkish Fed and BOJ pivots. So taking some off the table in tech makes sense to me.
Okay, that is a fair logic. So let's combine our views for Thursday's close. The final execution will be to sell $550 of XLC, sell $560 of XLK, and buy $1,110 of XLE.
Sounds like a plan.
And as always, the mandatory disclaimer. This is a live experiment and not financial advice. Past performance does not guarantee future returns.
Whether you're dodging tech dilution or hedging against geopolitical shocks, we want to hear how you're navigating this tape. Let us know your strategy in the comments below.
And something for you to mull over before we leave. As these historic corporate capital raises start completely dwarfing the liquidity of entire nations, what happens to global market stability when tech companies become vastly more powerful than the central banks trying to regulate them? Thanks for joining us, and we'll see you next time.